Welcome back, our co-host. He is the Hall of Famer, Matt Miller.
Good morning.
And he is the tallest coast we've ever had at 6 feet 7 inches tall, Johnny the Bod, Jonathan Bodwell.
Hey, man, good morning. Hey, can I make a comment about this document I have in front of me?
Please.
Would you introduce him first and then let me say, or do you want to introduce
I can do that.
Our guest?
Our guest is the funniest man in accounting. He is CPA Ken Apple. Ken, good morning.
Good morning, Rob. Good morning, Matt. Jonathan?
I want to say I have read a lot of stuff about the Big Beautiful Bill, and this is the best explanation of the tax provisions by far I have seen. This document that Ken brought us, thank you very much.
You should not be surprised.
He has boiled down all of the salient points and done it with handwriting far superior to mine, where I can actually read it.
But I just want to know how he took a 1,000-page bill and turned it into 4.
Common sense.
There it is.
Common sense, ladies and gentlemen. That's why Ken is here. We exchanged texts last week, and I said, Ken, can you come in once the bill was signed July 4 and do an hour with us on what this means tax-wise for people, businesses, and such, and to do it with your usual aplomb and flair and humor, which Ken is well known for.
Well, that's a lot of pressure.
Taxes can be funny.
Well, it depends on whether you got to pay, whether you owe or you got to pay. Oh, that's the same thing. Whether you owe or you get money back.
A good friend of mine once said, we were sitting at lunch. He's a lawyer, and we were sitting at lunch, and earlier that day, he had dropped off a tax check, a very large tax check.
Like one of those ceremonial ones?
He said, I just paid a very large tax bill. He said, but I'm okay with it. He said, because you know what's worse than paying a very large tax bill? Do any of you know? He said, not making enough to have to pay a very large tax bill.
That's a good problem to have this in.
Yeah.
Right? If you're paying a lot of taxes, you must be making a lot of money. Or you're doing a terrible job doing your own taxes.
Or you don't have someone like Ken to do your taxes, yes.
Absolutely, and I'm always telling people you're never going to be in 100% tax bracket, so make as much money as you can. You get to keep at least some of it.
It's true.
Unless you live in Maryland, then you could be in a 100% tax bracket.
Well, in all honesty, if you make a decent living and you have any sort of deductions and stuff, you need to have a tax professional do your taxes for you. I know my business inside and out. I don't know how to change my own oil. I take it to Peterson's. They change my oil. He knows taxes. Accountants know taxes. Don't try to do things you don't understand because it will cost you money. A friend of mine had been doing his own taxes for years, took his taxes to someone, and they ended up refiling 4 years, 3 years, 4 years, however far back they could go, because he'd missed so many deductions that it ended up being close to $10,000 between the current year and the previous 3 because he didn't go to a tax professional.
Amended returns, Ken.
Yep.
How many years can you go back to amend, Ken?
3 years.
3, okay.
That's the only thing I've ever asked you where your answer wasn't, it depends. There's the first 6 years it took me. Finally, I cracked the code.
Well, there is a small depends on it, but not worth mentioning. So it depends on whether your return was on extension or not as to whether it's three full years or not.
Well, let's get into the meat of this bill here and what it means to the average taxpayer. Ken, you can start from page 1 right at the top.
Okay, so there was going to be a tax bill in 2025 sometime during the year.
There had to be because this first one was expiring, right?
Right. The last major tax bill we had was in 2017. And you'll notice 2017, 2025, what they have in common is neither one of them are election years because we never get a major tax bill in an election year. I'll let you guys guess why. But unfortunately, those bills almost always come at the end of the year. So the 2017 tax bill was passed in late November of 2017, and of course it applied to 2018. So it was only a month before the tax year started that the bill was about. So I think because Trump is president is the reason that we have this tax bill earlier than in November. I think anybody else would have sent it back and forth and talked about different things until November and passed it. And that's great for accountants because we do planning, and if we don't know what the tax law is going to be in 2026, it's pretty difficult to do planning. Mm-hmm. So we're appreciative that the bill has passed already, and now for the rest of the year we can do planning for the next several years and know what the tax law is going to be. When they passed that tax law in 2017, most of what you heard about in tax provisions in that 2017 bill had to do with corporations, specifically C corporations or larger corporations. All of the provisions in that 2017 Act that affected C corporations were permanent, but all the provisions that affected individuals were temporary, and they all run out at the end of 2025, and that's why there was going to have to be a tax bill in 2025. Otherwise, we would revert back to the tax law that was in effect in 2017. So what this tax bill does is extends some of them permanently, some of them for a few more years, the provisions that were in the 2017 law, as well as a lot of new provisions.
All right, that moves us on to number 2 then, right? Provisions that were scheduled to expire.
Yeah, so the big deal in 2017 for individuals was the doubling of the standard deduction. So we raised in 2017, we raised the standard deduction for single people. It's approximately $15,000 now. It was half of that in 2017, and it does go up for inflation each year. What that did was it was a tax break for most people, and it took a lot of people that used to itemize deductions off of itemizing deductions and just taking the standard deduction. So it simplified things for a lot of people. If that provision were left to expire, we would go back to a much lower standard deduction, and more people would have to itemize their deductions again. So this tax bill makes that change permanent. So the standard deduction, as it was scheduled to go up under the 2017 tax bill, it's going up. It actually raised what was already in place for 2025 by just a little bit, and it will continue to go up in 2026 for inflation. So that's good news for all individuals who do not itemize their deductions. Their standard deduction is going to stay at the higher level than it used to be prior to the 2017 tax law. The other thing it did was it made the elimination of the personal exemption permanent. So if you remember back before 2017, we had a standard deduction. We also had a personal exemption. So you took the number of people in your household and multiplied that by the dollar amount for the personal exemption, and you got that in addition to the standard deduction. Well, when they doubled the standard deduction, they said we don't need that anymore, so we don't have a personal exemption. And in place of it, you get the doubled standard deduction, and for children, you got a much higher tax credit. So prior to 2017, the per-child tax credit was $1,000. When the new bill came in and eliminated the personal exemption, it doubled that credit to $2,000. This new bill makes that permanent and also raises it another $200, so it's $2,200 per child.
And does this still have that age 17
It does.
donut hole in it?
Yes. Yes. So what Rob's talking about is that tax credit for the child tax credit, is only good from newborn to age 17. And the presumption then is that if the child goes on to higher education, there's a higher education credit. However, most children at 17 aren't in college yet, so most people miss a year of the credit because the child tax credit expires, which drops that credit to $500 from $2,000 or what's now $2,200, but they're not in higher education yet. So that donut hole that Rob's talking about is that 1 year when your child is 17 that you don't get much of a credit for that child.
And we have no knowledge of why that age is singled out, Ken?
I think they just missed it. They were assuming that because some kids, if they're born at the right time, they don't miss a year because they're in college when they're 17. If your birthday is late in the year, you're probably entering college at 17 rather than 18.
Yeah, both of my kids were 18 when they went to college, so they both hit the 17 donut hole.
I turned 18 the week I went to college. Yeah.
Yeah, so you would have paid for the first semester of college, and so you're entitled to a credit for that, so you didn't really miss a year of the credit.
Yeah, I recommend better family planning, taking into account that age 17 donut holder. Moving along, Ken.
Okay. So one of the things that's become permanent now is the elimination of what they used to call miscellaneous itemized deductions. So keep in mind that even though the standard deduction has been doubled and most people are using the standard deduction, there's still a lot of people that are itemizing their deductions. And there was a catch-all category for years called other itemized deductions that included crazy things. Employee business expenses. So if you had to buy your own uniforms for work, for instance, something like that, your own tools. Investment expenses, if you paid a professional to help you invest your money, those were deductible. Tax preparation and planning fees, and of course that one should be deductible.
I agree. That's my Ken fee.
Those were in there. Safe deposit box rental, crazy things like that.
I remember those. So that's how old I am, Ken.
Right. So they eliminate. Well, 2016 they were still deductible, so you don't have to be too old.
He is though.
So they eliminated all of those in 2017, set to expire at the end of 2025. They are now permanent. And part of the reason they were eliminated is the IRS does taxpayer compliance audits. So if you get audited by the IRS, there's two types of audits. The one that we're all familiar with the most is they audited you for a reason. They found something on your tax return that they had questions about, so they came and audited you to ask you about that specific thing. A taxpayer compliance audit is a pure random audit. And taxpayer compliance audits are very comprehensive. So they take the tax return and they start at the top, and it says, it says on this return that your name is Kenneth W. Apple. Can you prove that? You have a birth certificate, you have a driver's license. It says here, this is your address. Does that match your driver's license? Social security number. I mean, you spend a half hour in a taxpayer compliance audit before we ever get to any numbers. But when they get to the numbers, they need proof of each deduction that's on your itemized deduction schedule. And what they found from taxpayer compliance audits, that this catch-all of miscellaneous itemized deductions is where people didn't have backup for the expenses that they were claiming. So a good way to eliminate that fraud was just to eliminate that deduction altogether. And nobody really complains about it because they doubled my standard deduction.
Make up for it there. All right. Next page, you lead with the SALT taxes, and this one particularly caught my eye, living in Maryland, where the taxes are pretty high.
Yeah, so if you go out and buy salt, you probably pay sales tax on it, but that's not what we're talking about. So SALT is an acronym that stands for state and local taxes, okay, which is a big category of itemized deductions on your tax return. So what makes up state and local taxes are state income taxes, real estate taxes, personal property taxes, fire and ambulance fees, sales tax, that kind of thing. All of those are considered state and local taxes, or SALT. And prior to 2017, the deduction for those was unlimited. So if you paid $50,000 in combined real estate taxes, state income taxes, you were able to deduct the entire $50,000.
Ken, let me ask a quick question.
Yes.
So if somebody saved all of their receipts for an entire year for everything they bought down to a candy bar, they could write their sales tax off?
Okay, so you have a choice of writing off your state income tax or your sales tax.
What if your state income tax? What if you're low income, your state income tax, you really, it doesn't come quite high enough? Can you write off a portion of your state income tax and your sales taxes?
No,
Okay.
It's either or. So
Because
if you happen to live in a state that does not have a state income tax, which there are quite a few,
then you would
then
write
you're
off.
going to take your sales tax.
Then you take your sales tax, which could lower your income, which for lower income people could add to the earned income credit and stuff like that, because their income would be lower versus their family size.
No, so itemized deductions do not affect the earned income credit.
Okay.
No. So
And there are tables for figuring sales tax if you didn't save your candy bar receipts.
yes, so if you're going to choose sales tax because it gets you a higher deduction than income tax, than state income tax, then you can either use the IRS approved chart, which says based on how much money you made, this is how much we think you paid in sales tax based on the sales tax rate in the state that you live in. Or you can do as you say, Jonathan.
Yeah.
You can keep every receipt. And I've had clients that have done that. They've
Wow.
got an entire desk drawer of receipts. And if you add them all up and you get a number higher than the table, you can take the higher number.
Those are the fun ones, right? Those are the fun.
Also, in addition to the table, if you make a major purchase, say an automobile, for example, and you pay a title tax on it, you can take the title tax in addition to the chart based upon your income.
Okay, thank you. I had never known the sales tax was a part of that. This is really good, really informative. Thank you.
Yeah, otherwise it would be unfair to people that live in states that don't have an income tax, because most of those states have a higher sales tax. So they're paying a state tax. It's just in the form of a sales tax rather than an income tax.
So the limit now to all those state and local taxes, Ken, is $40,000.
Okay, so in 2017, they limited, it used to be unlimited, they limited it to $10,000. And what's peculiar about what they did in 2017 was the limit was $10,000 for a single person. It was also $10,000 for a joint couple. You would think that it would be $20,000 for a joint couple, but it's not. It's 10. So this is one of the provisions that went back and forth between the House and the Senate. A lot of people wanted to keep it at $10,000. Representatives from high income tax states wanted to raise it. The compromise was that they did raise it, and it will be $40,000. But that's not a permanent provision. That's one of the temporary provisions. So it's good through 2030.
And is that 40,000 aggregate, single or couple?
No, it's still 40,000 for an individual and 40,000 for a couple.
Okay.
Which, in my practice, $40,000 is going to capture everybody.
Right. Oh, yeah.
I don't think I have anybody that pays more than $40,000 a year in SALT.
I just find it always weird in tax law, and you can speak better to this, of course, when there is no, you all of a sudden you're married and there's no difference as far as how you're taxed. You lose out on, there's certain things you lose out on because you're married.
Yeah, this is definitely comes under the category of a marriage penalty. Because if I have under current law, if I have two single people living together, they each get $10,000 SALT. If they get married, they get $10,000 together. So it cuts their SALT deduction in half. So why they did that, I don't know. You'll have to talk to your representatives about that.
Just one more reason marriage didn't work out for me. I'm going to blame tax law.
It's all about math.
So with the current limit at $10,000 and the standard deduction being around $30,000 for a married couple, most people still don't itemize even though they have $10,000 worth of SALT, because they got to find $20,000 worth of other itemized deductions before they exceed the standard deduction. Now that it's raised to $40,000, there'll be a lot more people going back to itemizing their deductions.
Which, as I found out in Maryland, can affect your state income taxes at the end of the year.
Yes, well, when they passed the tax law in 2017, Maryland had in place a law that said you can itemize your deductions on your Maryland income tax return only if you itemized your deductions on your federal tax return. So when the federal government doubled the standard deduction, that took millions of Marylanders out of itemizing deductions. So when they went to file their Maryland return, they were stuck with the very low Maryland standard deduction. So for my Maryland clients, I actually run it two ways every year. I say, okay, they're close to the standard deduction for federal. Let's say the standard deduction's 30 and they've got 25,000. Well, what if I force itemize, which the federal government will let me do? If I say, hey, I'm entitled to a $30,000 standard deduction, but I'm going to itemize deductions and they're only $25,000, so I'm only going to take a $25,000 deduction instead of 30. Of course, the federal government's fine with that. They don't have a problem with that because I'm going to pay more federal tax. But because it allows me to itemize my deductions in Maryland, I might save more Maryland tax then I'm giving up on my federal return by force itemizing. So when that came about, the Maryland legislators said, yeah, we understand it, we're going to fix it. And I think when they figured out how much extra revenue they were making, they just never fixed it. So it's still that way.
And yet still have a massive budget deficit.
Yeah, well,
Don't get me started, Ken.
you're the only one in the room that lives in Maryland.
The People's Republic of Maryland.
The prom. Yeah. That's why Carrie had the way she had with the whole Stephen King thing.
I'm really interested to hear about the next bullet point, Ken.
Okay, so the next bullet point is a thing that we abbreviate QBI as an acronym for Qualified Business Income Deduction, and that was a new deduction that was created in the 2017 Tax Act, and it was done to put small businesses on the same level as large businesses. So as I said earlier, the 2017 Tax Act had a lot of permanent provisions for big corporations. And the one that you heard the most about was setting the tax rate at 21% for corporations. So they said, well, if we do that and we do nothing else, all these little tiny businesses that are operating as sole proprietorships or LLCs or S corporations, they're all going to incorporate and become C corporations to take advantage of the low rate. So the way they fixed that was to create the Qualified Business Income Deduction. So for small businesses, when they go to pay just the federal income tax on their business income, they take a 20% deduction before they pay their federal income tax. So they're only paying federal income tax on 80% of their profit at whatever tax bracket they're in, which puts them on a par with that lowered 21% C corporation deduction. Does that make sense?
Sure it does.
Okay.
Yeah.
It's a complicated concept, so I'm never sure if I'm getting through or not.
I got 2 minutes left, so whatever one you're going to do next, make it a simpler one as opposed to a more complex one.
Hold on, let me ask, the QBI, when it was put in, that was permanent when it was put in, or
No.
does this make it permanent?
No, and that's what was strange, because the 21% corporate rate was permanent,
Okay.
but the qualified business income deduction for small businesses was temporary. So now it's permanent.
Now it's permanent.
Under
Okay.
the new law.
Oh, I got a simple question for you heading into the break here, Ken. In regards to the sale of a house and the profits from the sale of a house, did anything get changed in this new bill as opposed to the way it had been?
Nothing got changed in the new bill. There were some people lobbying for a change just because the price of houses has gone up so much.
So the appreciation has become greater, and it's more likely you'll pay a tax now.
Right. So that provision was never indexed for inflation. So if you're a single person and you sell your primary residence and it qualifies because it's been your primary residence for at least 2 out of the last 5 years, you can exclude from income tax up to $250,000 worth of profit. A married couple can double that, $500,000. It's not unusual for me to see people selling their houses and making more profit than that, and having to pay tax on some of the profit on their primary residence.
Does it get taxed as ordinary income or capital gains?
It's long-term capital gains by definition.
Which is a fairly friendly tax relative to the others, is it not?
Can be.
Long-term capital gains. But then you get with that 3.8% Medicare surcharge tax on top of it
Yeah,
because
it's
you're
very
rich.
Good. Very good.
Yeah, I ask you a lot of questions. And is this, that profit is, and I don't, just real quick, is that once in a lifetime?
No.
Or you can do it every time you buy a house?
You could conceivably do it every 2 years.
Every 2 years. Okay, good. Ken's staying around. We have more questions for him. If you have any, post them in our Facebook section. We'll ask those as we go along here, or you can call them into Colin McLaughlin. He'll relay those to me at 304-263-6540. In studio with the Hall of Famer, Matt Miller.
I'm sure they will be talking about the Home Run Derby today on the Sports Mix. Pirate.
O'Neill Cruz.
O'Neill Cruz, yeah. Had a very good showing, so you got to be excited about that, maybe.
513-foot home run.
That was a blast.
Tied the, literally, tied the all-time record.
Who will he be with next year or the year after? That's the question.
I think they've got 4 more years of control on him. He's tied to the mothership for a little while.
What about, who was the kid from Hedgesville who got drafted by the Yankees yesterday?
Oh, I didn't know.
Colin?
I didn't know there was a kid from Edgeville.
Anybody? Bueller?
I don't know. Do you know?
Can't remember his name. Is Colin back there still?
I hadn't seen that.
Colin. Yeah, Colin's there. Do you got a name, Colin? Wait, he's getting dressed.
It was all over the.
Getting dressed is not the correct statement there. Just putting a headset on, but it was Kyle West.
Kyle West, thank you.
Ah, there you go.
Yes, he was drafted by the New York Yankees.
Good job.
What year did he graduate from Hedgesville?
That I don't know off the top of my head.
Does he bat right or left?
Also don't know that off the top of my head.
Does he throw right or left?
Left-handed batter, and I forget what school he went to beforehand, but finished his last 2 years at WVU and was a key part of their success each of these last 2 years at WVU.
Nice.
Very good player.
A lot of people in our comment community yelling the name out too, Kyle
Yeah.
West. Thank you, Colin.
You're welcome. I believe he will be at the Area 4 tournament on Friday night at Hedgesville High to throw out the ceremonial first pitch, unless he needs to be called somewhere else with being drafted. So
Very nice. Okay.
What round was he drafted in?
I'll look it up and text you.
Thank you, sir.
Somebody in our Facebook section will know. You can go back to being undressed, Colin. Thank you. Ken, we were talking about appreciation on a home and how the tax laws have changed on that over the years. And you were getting into that before we stopped on the break. One of the things we didn't get to yet is improvements that you make on your home, which can possibly reduce your exposure to the capital gains on the appreciation of the home.
Okay, so I don't know how much of that was on the air or off the air.
None of that part was.
So there was nothing in the new tax bill that affected the sale of your primary residence. Those rules stay the same. And what those rules are is if you're single and you qualify, your home qualifies as your primary residence, which basically means it was your primary residence for at least 2 out of the last 5 years before you sell it, you can exclude from taxation up to $250,000 worth of gain. If you're a married couple, that's doubled to $500,000. And because the price of homes has accelerated so much, there was lobbying on this bill to increase those limits, but that did not happen. So those are still the same. So your profit on your primary residence would be the contract price I sell it for minus most of my closing costs minus my basis. My basis normally would be what I paid for it plus any improvements I made to it along the way.
So I've been in my house 25 years. We have, since we bought the place, we have put on a deck. We finished the basement. We had a new roof. We replaced the windows. We repainted the place. We tore the old carpets out after 20-something years and put in a different type of flooring. What of those are considered to be deductible improvements or improvements that would add to the base cost of my house?
Okay, so any addition would be an improvement. So your deck is an improvement. You're replacing your windows is an improvement. Replacing the roof depends on when you did it. So if you had a new house and 30 years later you put a new roof on it, that's not an improvement. That's just a maintenance. Painting the inside is not an improvement. That's just maintenance. What else did you say you did?
That's a good sampling.
Yeah.
Finish the basement.
Finish the basement. That's an improvement for sure.
Yeah. The 1,000-foot TV I put down there, is that an improvement to the house too, Ken?
It depends on whether it goes with the house when you sell it.
If it stays with the house, it's part of the improvement?
Sure.
Oh, well, heck, I don't need to haul that thing. It'll be old technology by then anyway. They can keep
Right.
it. It's amazing how the price of those things has gone down while the size has gone up.
But what I run into pretty much routinely is people that are selling their primary residence who did not buy it. Okay, so a lot of people are gifted a house or inherit a house. And so their basis is not what they paid for it because they didn't pay for it. So the rules are completely different
What's your basis
on
in
a
that
house that you inherit as opposed to a house that's gifted to you or titled over to you before death.
Is that like inheriting an IRA or something like that?
So when you inherit an asset, your basis in that asset is what it was worth on the day that the person died that you inherited it from. Okay, so you get what they call a stepped up basis. So if I paid $100,000 for my house and it's now worth $300,000, and I die and leave it to you, Rob, your basis in the house is $300,000. So you sell it for $300,000, you don't pay any tax because $300,000 minus $300,000 is zero. If I gift that house to you before I pass, I gift you my basis in the house, which is $100,000. Now you sell for $300,000. You pay tax on the $200,000 profit.
First of all, thank you for considering gifting me your house. I appreciate that.
The
How do we get this into an actual action as opposed to just the consideration phase of our relationship, Ken?
I think you have an attorney that appears on here pretty regularly that can take care of that.
Mr. Ferretti? I think so.
let me ask this. So, how is that determined? So, say a relative dies, they gift you a house. Is that number determined when you take possession of the house, or is it 20 years later? Somebody has inherited a house. 20 years later, they're selling the house. Are there then like forensic appraisers who go back and say, okay, back on July 19th, 1999, the house was worth this, or is it determined when the transfer's made, or they have to look back and guess?
Wow. Okay. So you sound like one of my clients. So first, your premise is that somebody died and gifted you a house, which is not correct. So if somebody dies, you inherit a house.
Right.
All right. If you get the house before they die, that's a gift.
Right.
And the answer is completely different.
I'm talking an inheriting
All right. That's not what
situation.
you said. You said somebody dies and gifts you.
Well,
a house.
I mean, it is kind of a gift, but if somebody dies, Ken, and you inherit the home,
Yes.
say you inherit the home
And
in
your
2000.
your basis is fixed by the appraisement of estate that's filed with the local court.
Okay.
Okay, so the executor of the estate, one of his duties is to list all the assets that the decedent had when they died, including that house. And whatever he says the value of that house is, which gets approved by the county, that fixes your basis forever in that house.
What if it's a TOD? What if it's a transfer on death deed and it does not
Same
pass through
answer.
probate?
Doesn't matter whether it goes through probate or not. Both probate and non-probate assets are listed on the appraisement of estate.
Okay.
Can mortgage interest deduction limited to the interest on the first $750,000 of mortgage debt? Most of us probably will never have to worry about that, but some of us do.
Okay, so amazingly, before 2017, that limit was $1 million. Okay, so you can have up to $1 million worth of mortgage debt and deduct the interest on the entire $1 million. In 2017, it limited that down to $750,000, and this tax bill makes that $750,000 permanent.
Now, does that have to be from one home, or can that be from maybe I own 10 buildings? Does that all accrue together? Isn't it lump them out?
So mortgage interest has its own definition in tax law. Okay, so the short answer to your question is 2 houses at most.
Gotcha.
All right, but if you have 8 other houses that you're doing something with other than living in, like renting out, they have their own rules, and the interest is deductible against the rent income, that kind of thing.
Gotcha.
If you have a business building, it's deductible against your business. So most of my clients don't have a problem with this staying at $750,000.
I have 2 questions, Ken, because I know we're running short on time because we've gotten you to delve deeper than we thought. Can you go through the no tax on tips and the additional standard deduction for seniors? Because I think those are 2 things that our listeners are definitely going to want to hear about.
Yeah, so we're pretty much finished with all the
overtime.
all the things that were set to expire but are not going to expire. But there are new tax provisions in the bill, and the ones that everybody has heard about. The first one is no tax on tips, which isn't actually true. Okay, so it's a good thing for everybody to say no tax on tips, but it's not really true. So it only exempts the first $25,000 of tips in a year, and it only exempts it from federal income tax. Okay, so you're still going to pay Social Security tax and Medicare tax on it. When they first brought up this idea of no tax on tips, I said, well, are they going to exempt it from Social Security and Medicare? If they do that, then people who are tipped employees all their lives, when they go in to apply for their Social Security check, they're going to say, who are you? You've never paid into Social Security. So they're still going to keep on paying into Social Security and Medicare on their tips. They're only going to be exempt from federal income tax on up to the first 25,000, and that's a temporary provision. It's only good through 2028, and it phases out on income. So if your income is high enough, you don't get to take that deduction. The other one we hear a lot about is no tax on overtime pay, which isn't exactly true. So it only exempts the first $12,500 of overtime pay, which for most people that are getting overtime, that's not a lot of money in a year. Okay, but you know, if they're going to exempt $12,500 of my pay, fine, I'll take it. That doubles for a joint return to $25,000. Again, it's only for 2025 through 2028, and it phases out at income levels. So if you're a union worker, for example, and you get a lot of overtime pay, this probably isn't going to apply to you, because your overtime pay on its own probably puts you over the income limit to not be able to take advantage of this rule. So it sounds good, it's a good soundbite, but both of those aren't nearly worth what you would think that they were worth.
Those tricky
Just more helps
politicians.
lower income people.
Yeah, so low income tip people probably aren't paying federal income tax on their tips already.
Right.
Okay?
Right.
Because of the high standard deduction. Now, one tax provision that is not in this tax bill is no tax on Social Security benefits. Now, how many people have heard that that's in there?
Yes, I've heard that.
I've seen that on the Facebook, so it must be true.
Not only that, if you're on Social Security now, or you're on Medicare, and you have an account with the Social Security Administration, you got an email a couple of days after the bill was signed telling you by the Social Security Administration that for 90% of the people that receive Social Security benefits, this bill makes it so they're not paying tax on their Social Security. It's just dead wrong. Okay, so there are no Social Security benefits provisions in this tax bill, none. The only thing that's in there that you can contort the bill to say maybe I'm not paying tax on as much of my Social Security benefits as I was before is they expanded the additional standard deduction for seniors. So if you're over 65, you get an additional $6,000 standard deduction, but you use that against any taxable income that you have. So you can't really connect it directly to your Social Security benefits. And most people that are paying tax on their Social Security benefits are paying tax on a whole lot more than $6,000 anyway. So there is no provision in this tax bill to exempt Social Security benefits from federal tax.
Why don't they just tax my Social Security benefits that are in excess of what I contributed to Social Security over the years?
Part of the law that's in effect actually did that. So prior to 1986, nobody paid tax on their Social Security benefits. There wasn't even a place on the tax return to put it. Okay. In 1986, they passed a tax law that said if you're rich, quote unquote, we're going to tax 50% of your Social Security benefits. So if you worked for somebody else your whole time that you worked, you provided for half of your Social Security benefits and your employer provided for your other half. So at least it makes some logical sense to say I'm going to pay tax on half of my Social Security benefits. I'm not going to pay tax on the half that I contributed, but I'll pay tax on the half that that my employers paid in for me. Mm-hmm. That made some logical sense. Later on, 1991, they raised it to 85%. Logic went out the door. They also did not index any of that for inflation. So the definition of rich in 1986 is still the same definition in 2025.
Rich in spirit.
$27,000.
And this bill did nothing to change that.
What's that? What is that?
So it's half of your Social Security benefits plus all of your other income. For a married couple, if that's more than $32,000,
you're rich.
We're going to tax half your Social Security benefits. If it's more than $44,000, we're going to tax 85%. So virtually everybody these days is paying tax on at least some of their Social Security benefits, and this bill did very little to alleviate that.
This one kills me because I'm going to take this money from you, and when I give it back to you, you've got to pay me a tax to give it back to you.
Now you're showing your age.
Oh, I show it in many ways, not the least of which is the hair on the top of my head.
So if you ask a
Or lack thereof.
if you ask a 20-something about the payroll taxes that are coming out of their paycheck, they just regard it as a payroll tax. They don't regard it as the government's taking this money out and investing it for me and is going to pay me back when I'm 65.
Because they don't think they're getting it back.
That's what you and I remember, but that's not what the young people remember. And they've been conditioned to look at it that way. Everywhere in tax law, it just refers to payroll taxes. It doesn't say anything about we're going to take this out and invest it for you and give it back to you in your old age.
And tax me for it, yeah. They brainwashed these younger people. That was before the brainwashing took place, Ken. All right.
Let me ask a quick Social Security question.
Good.
I know there was talk of raising the income level for taking Social Security tax out. This bill didn't end up doing any of that, right?
No. I'm not sure what you mean
What
exactly.
I mean by what is the number up to what income level do you pay Social Security taxes at this point?
Oh, it's
134.
no, it's like
while you're working, you
160
mean.
something.
While you're working 160 something.
Yeah, it's gone way up. It's in the 160s now.
Goes up for inflation.
Because I had heard they were looking at making it, 250, 500,000 to, basically reset Social Security and make it more stable.
Right. Yeah, there's always talk of that, but that is indexed for inflation, and it does go up every year. So they take in more money for Social Security taxes each year on high-paid individuals because, if you're making $200,000 a year, you used to only pay in on 125 of that. Now you're paying in on 160. And one of these days it'll be on the whole 200. And several years ago, they took the cap off of the Medicare tax. So if you're making $900,000 a year, you pay Medicare tax on the whole $900,000.
Now, let's get to auto loans because a lot of people think they're going to be able to deduct the auto loan interest. And since a new car costs as much as what I paid for my first house, they're probably pretty excited about this.
Wow, you're showing your age again. All right.
Yeah, I am.
It's difficult for him to not.
Sounds like my grandfather talking over there.
You get crankier as you get older, don't you?
Yeah, so this is a provision that is going to help almost no one, but it's there, so we can talk about it. So the interest on an automobile loan has not been deductible for, gosh, I don't know,
That's the Reagan years.
30 years probably, maybe more. Probably goes back to 1986.
It does.
So prior to 1986, you could deduct interest that you paid on any loan, credit cards, auto loans, house, home equity, whatever. That all changed in 1986, and consumer interest was no longer deductible. Well, this brings back that piece of consumer interest. It's interest that you pay on a car loan if the car was manufactured in the United States. The maximum amount of interest you can deduct is $10,000 per year, and there's a relatively low income limit. So if you can afford a car that you're going to pay $10,000 a year interest on, you're not going to qualify for this deduction anyway. So it's going to help almost no one. And then if you do fit in that little box, then it's just one of your itemized deductions, and your itemized deductions still have to exceed that increased standard deduction before you get it.
So it's good publicity, and that's about it.
That's about it.
What about this senior thing, the extra deduction for seniors?
Yeah, so there is an extra deduction for seniors, and that's what people are hanging their hats on to say part of your Social Security benefits are not taxable anymore, but it's not true. It's a $6,000 additional exemption for some seniors, that is people over age 65. It phases out at a relatively low income level, so that's why it's only for some. But if you're below that income limit, you get an extra $6,000 standard deduction on top of your $30,000. So if you got a married couple over 65, that's 12 on top of the 30. They've got 42,000 now that they can make and not pay any taxes.
So that's another 12,000 of their Social Security that they would not be paying taxes on, basically. I mean, that's how they're getting around it.
Correct.
Let me ask one more quick question. I know we're right at the end. The Trump accounts.
Yes.
What are the Trump accounts?
So I guess this was his attempt to have his name permanently in tax law. So it's kind of like a Roth IRA, right? It's named after the guy named Roth. So it's a Trump account. It's yet one more savings account. that will probably not amount to much. But it is important if you're in your childbearing years, because any child born in 2025, 26, 27, and 28, you can open up one of these accounts, and the first $1,000 deposit will be made by the federal government into that account.
Wow. That is great.
And Ken, charitable deductions, you can now actually write those off aside of your standard deduction.
Yes. So when the 2017 tax law was passed, all the charities were afraid that people weren't going to donate anymore because they couldn't deduct their charitable contributions.
10 seconds.
That's important in here. $1,000 for single, $2,000 for joint. You can deduct your charitable contributions in addition to your standard deduction.
So that helps everybody.
Exactly.
All right. That's a good one. We like that
Yes.
one. All right. We're back with the final minute with CPA Ken Apple after these.
That is a good.
Matt Miller gets the final question.
All right, Ken, 1099 miscellaneous forms. What's the info on that?
All right, so the limit on 1099 miscellaneous and now NEC forms has always been $600. It's been $600 for decades. So it's still $600 for 2025, but starting in 2026, that level has raised to $2,000. So if you pay anybody less than $2,000, you don't have to do all that reporting.
If I make $1,000, do I have to report it?
Absolutely.
But they don't have to give me the report that I made it.
That's correct.
Gotcha. Ken, thank you. Your title as Funniest Man in Accounting continues for yet another appearance. Mr. Bodwell, Mr. Miller.
Thank you, sir.